The Intelligent Investor by Benjamin Graham is a classic book of investing, often regarded as one of the best resources for understanding value investing. Graham's philosophy emphasizes the importance of long-term disciplined investment strategies. Here is a detailed summary of a book's key point concepts. The philosophy of value investing. Graham discussed between two types of investors: speculators, people who try to time the market relying on short-term fluctuation to make a profit; investors, people who buy securities based on fundamental analysis with a long-term outlook. He believed that an intelligent investor should focusing on finding undervalued stocks with a margin of a safety and avoid speculative investment. Second, the concept of margin of safety. This is a cornerstone of Graham's philosophy. The margin of safety means investing in a security at significant discount to their intrinsic value, thus reducing the risk of loss. This margin allows for some error in analysis or unforeseen market events, which offer protection for the investor. Third, Mr. Market. Graham introduced the metaphor of Mr. Market to explain the erratic nature of stock price. Mr. Market is an imaginary person who offers to buy or sell your stock every day at prices that are influenced by his mood. Sometimes Mr. Market is overly optimistic and inflates price, while other times he is overly pessimistic, leading to under-evaluation. The key for an intelligent investor is not to follow Mr. Market mood, but to take advantage of his irrationality when it creates opportunity. Fourth, investment was speculation. Graham emphasized the difference between investing and speculating. Investing required through analysis, a margin of a safety, and the expectation of reasonable returns. Speculating, on the other hand, it based on price movement and market trend, with the goal of achieving high short-term profit. Graham warns against speculation and urges investors to focus on value investing, which is based on sound financial principles and the potential for long-term growth. 5. The two forms of investing: defensive and enterprising. Graham divides investor into two categories: defensive investor, those who seek a safe and steady return with minimal effort. This approach involving buying and holding a diversified portfolio of stocks and bonds. Defensive investors should not try to time the market or actively pick stock, but should instead focusing on minimizing risks and maintaining a diversified portfolio. The enterprising investor, these investors are willing to devote time and effort to analyze individual stocks and other investment opportunities. They can afford they can afford to take one more risk and potential achieving higher returns. Graham advised enterprising investors to focus on value investing, identifying undervalued stock, and taking advantage of market inefficiency. 6. The role of bond. Bonds are important part of a investor portfolio as they offer stability and income, especially for defensive investors. Graham discussed the importance of balancing stock and bond based on an investor risk tolerance. He also emphasized the significance of buying high quality bonds that are likely to hold their value in long term. 7. Stock market fluctuations. Graham discussed how stock markets are subject to cyclical fluctuations driven by human emotion, market psychology, and economic factors. He explains how market volatility can create both opportunities and risks for investors. Instead of reacting to short-term market movements, an intelligent investor should remain calm, stay focused on long-term goals, and take advantage of temporary market downtrend to buy undervalued stock. 8. Analyzing stock and bonds. Graham provided detailed guide to analyze individual security. He stresses the importance of understanding a company's financial, including its earning, assets, liability, and cash flow. He also highlights the importance of assessing the company competitive positions, management, and industry outlook. The goal is to find securities that are priced below their intrinsic value, providing a measure of safety. 9. The role of dividends. Dividend plays significant role in long-term investment return. Graham believes that companies that pay regularly dividends are generally more stable and have a lower risk of bankruptcy. He also notes that dividends can provide a reliable income stream, particularly for defensive investors who are looking at stable returns. 11. The importance of emotional discipline. Graham states that emotional discipline is key to success investing. Investors should not let fear or greed influence their decision making. Instead, they should stick to a rational investment strategy even when the market condition seems unfavorable. Emotional decisions such as panic selling during a market downturn or buying based on a hype often lead to poor results. 11. The intelligent investor approach to market cycle. The market goes through cycle of optimism and pessimism, but Graham argued that this cycle should not show an investor strategy. During bull market, when prices are inflated, he advised investors to be cautious and avoid chasing stocks. During bear market, when prices are depressed, investors should be view this time as opportunities to buy quality stock at discounted price. 12. The role of speculative investment. While Graham warns against speculations, he acknowledged that speculative investments such as hot stocks or high growth companies have their place for enterprising investors. However, he cautioned that such investments should be made with carefully analysis and with the bond of a diversified portfolio. Speculative investment should not make up the majority of an investor holding. The importance of diversification. Diversification is a crucial risk management tool in investing. The Graham suggests that investors should spread their investment across different asset classes and industries to reduce their risk to loss from any single investment. A diversified portfolio is more likely to weather market downturns and provide more stable return over the long term. 14. The value of patience. One of the most important lessons is the intelligent investor is the value of patience. Graham states that successful investing takes time and that investors should not expect to make quick profits. By sticking to a disciplined strategy of buying undervalued stocks with a margin of a safety, reinvesting dividends, and avoiding emotional decisions, an investor can achieve long-term financial success. 15. The margin of safety in action. In the final chapter, the Graham reinforced the idea that an investor should always have a margin of safety, meaning they should buy securities only when their price is sufficiently below their intrinsic value to absorb any potential losses from errors in judgment or unforeseen circumstances. The key we takeaways: focus on value investing. Invest in undervalued stock with a margin of safety. Distinguish between investing and speculating. Diversify your portfolio to reduce risk. Patience and emotional disciplines are critical to long-term investment success. Both defensive and enterprising investor can benefit from Graham strategies, but they should tailor their approach to their individual risk tolerance and long-time commitment. Stick to a long-term strategy and avoid reacting to short-term market fluctuation. In total summary, the intelligent investor is a guide for anyone looking to build wealth through intelligent discipline and value-based investing. The key is to understand the intrinsic value of securities, maintain a margin of safety, diversify and stay emotionally detached from market fluctuation. Graham insights have made this book as essential read to anyone serious about investing.